Summary of The Intelligent Investor: The Inside by Benjamin Graham. In The Intelligent Investor Method, not much time is spent discussing the technique of stock analysis, and instead, much emphasis is placed on investment principles and investor attitudes. Great emphasis is placed on investment principles and investor attitudes. Although it was first published in 1949, the basic principles of investing do not change from decade to decade. Benjamin Graham teaches us three things: how to minimize the chances of suffering potential losses and how to maximize the chances of achieving sustainable gains, how to think about self-professional thinking that prevents investors from reaching their full potential. To be a smart investor, be first, be patient second, be disciplined third, to be eager to learn new things fourth, being able to control your emotions and think for yourself. Graham says that the intelligence required to be a good investor has more to do with personality than smarts. Through a summary of the book The You Are Committed, presented to you by the Sudanese Developer website, we will introduce you to some of the main investment methods and Benjamin Graham's formula for smart and successful investment. The Intelligent Investor explains value investing, which focuses on generating consistent, long-term profits by ignoring the current market and choosing companies with high intrinsic value. Favorite quote from the author: "Those who do not remember the past are doomed to repeat it." Summary of the book: Benjamin Graham was one of the greatest investment thinkers and stocks of all time. Although his widowed mother lost all her money in the financial collapse of 1907 and his family fell into poverty, this did not stand in the way of his studies at Columbia University and going to work at. He has gone from writer to analyst, then to partner. Prior to running his own investment firms, as a result of all of the above, he has amassed a wealth of historical and psychological knowledge regarding financial markets, spanning several decades. He shared that knowledge in his book The Smart Investor. Since the book The Smart Investor was first published, there have been two investment options. Two extras are available to protect investors from inflation risks. These are REITs, companies that own and collect rent from both residential and commercial properties. Treasury inflation-protected securities, a U.S. government bond that automatically increases in value as inflation rises. The authors of this book have many students. Among his most famous students was Warren Buffett, one of the richest people in the world, and the greatest investor. He read this book, applied what it said, and called it the best investment book ever. Here are three key lessons from Benjamin Graham's book to help you get started in investing. 3 principles of smart investing are long-term analysis, and protect yourself from losses, and not seek impossible profits. Never trust the market. It can be very irrational in the short and medium term. Stick to a strict formula that you can make all your investments, and you will be fine. Are you ready to become a smart investor? Here are the lessons from the book. There are 3 principles of smart investing. It is also often called value investing, and smart investing, according to Benjamin Graham, is based on three principles. A smart investor always analyzes the long-term investment and management principles of a company before investing in it. A smart investor always protects himself from losses by diversifying investments. The smart investor is never looking for big profits, but focus on safe and steady returns. A famous quote from Warren Buffett says there are two rules of investing. The first rule is never lose money. The second rule is never forget the first rule. This is exactly what smart investing is. No one can predict the next technology company, but everyone can protect themselves from losses through careful analysis. Smart investors find stocks with the difference between their current price and the actual value of the company, and this is based on reading company data collected from looking at the company's history and management value. The smart investor invests in a few of those companies so he doesn't lose everything when things go wrong, and then comes back to a point zero again and must be perfectly happy collecting 10% or 12%. Or even 15% per annum in returns. The market never agrees. Graham's most famous analogy is Mr. Master Market, portraying the entire stock market as one person. If you could imagine Mr. Market appearing on your doorstep every day relaying different prices for different stocks, what would you do? According to Benjamin Graham, better to ignore him completely one day. After a day, at times, the prices he will tell you may seem suspiciously cheap, and sometimes astronomically high, for Mr. Market is not very clever and quite unpredictable, and suffers from serious mood swings. For example, about a month before the release of the new iPhone, always stick to the strict formula, and you'll do well finally. To keep you away from the emotional stress of investing in the market, you should always stick to a strict formula when investing. Graham calls it the investing formula, but it's more widely known as the dollar cost average. What it means is that you simply set a fixed budget. You will invest it every month or quarterly, and then invest it in the stocks you chose previously, regardless of the price. For example, invest 10% of your income each month, put that money into your investment account, and then invest it in stocks you already own. This is somewhat emotional, as it requires you to invest the same amount over and over again, no more. When stocks are cheaper, no less. When stocks are expensive, it is a great way to protect yourself from losses, which can occur if you invest a large amount before the crash.